All right, ladies and gentlemen, welcome again to Purpose Money Financial School. This is our third class, the third time that we're doing this. I'm excited that you came and joining us, and we're going to have an awesome time. Welcome, welcome, welcome. So we already opened with word of prayer, and people have been welcomed to the class. The background has been laid. Now we're moving forward. As we go forward, I want to start with reading a quick scripture here, and then it's going to guide us. Remember, this is purpose money. Purpose money. It's not just money. It's about why you're here on earth and why money is part of that. So it is important we learn from that perspective. And this aspect distinguishes this class from other classes, because we're not just learning about money. We don't want to just be greedy and accumulate money for no reason. But we believe God positioned us here on earth for a reason, whether it's to take care of your family or other people in your circle, or you care for other things in your community, in your country, around the world. For whatever reason it is, purpose is key. Purpose is reason why something exists. So we exist for a reason. We are here because I believe God put us here to represent Him here on earth. And in order for us to do that, money is involved. Money is a part of that. So we need to learn about money and how to steward it well once we earn it. But also, stewarding money means that we have to also grow that money so we can be able to be even more functional. With that in mind, we're going to go to the book of Matthew, chapter 25, and I'm going to read just a little bit from verse 14, and we're going to keep on going. The Bible says in Matthew 25, verse 14, "Again, the kingdom of heaven is like a man traveling into a far country, who called his own servants and entrusted his goods to them. To one he gave them 5 talents, to another 2, and to another 1, to every man according to his ability. And immediately he took his journey." This Bible, I expounded it. This verse, this passage of scripture, I expounded it very well in my book. By the way, for those who are new here, I wrote a book. This is a book you must read. I believe that. Purpose Money. It's on Amazon, Barnes and Noble, Walmart, and I have some physical copy for those of you who are local. But I expounded this because this is Jesus teaching his disciples concept about investment and how it works. He said this master called his 3 servants. He gave one 5 talents, another one 2 talents, another one 1 talent. And he took off. He didn't tell them what to do with it. But we know the story. The one who was given 5, he took that money, that talent, whatever he was given, and he multiplied that 100%. The one who was given 2, he did the same. He invested that, and there was 100% return. The one who had 2, he brought 2 more. My friend who was given 1, he decided not to do nothing with it. He took it and buried it. And when the master came back, he was asked, "Why didn't you do what others did?" He said, "Oh, master, I know that you're powerful. You have the ability. You reap without sowing. You do these miracles. I just put it on the ground because I know you, master, can do anything that you want to do." And the master said this, "Take the one he had and give it to the one who had 5 and brought 5 more. So to he who has something, much will be increased to them." That's how it works. If you know how to work with money, if you know how to grow money, money will be increased to you, because money is attracted to somebody who knows how to steward it well and grow it. Jesus was teaching the concept of investment. And in this class today, I am going to talk about investment. So with that said, we're going to look into the whole thing about purpose investment, global investment guide, options for every investor worldwide. This is a master course. It's very important, very essential, and I'm glad that you're here to benefit from it. Now, moving forward, agendas today will be investment fundamentals, investment vehicles types, local to global opportunities, platforms, brokers, tools, building your strategy. All right, let me read the text and see what it says, because I don't want to be missing out. Okay, I already saw those things. Great. So if you have anything, if I'm missing out anything, you put in the text while we continue, so I don't miss out on anything that is going on. And I'll be checking now and then. I'll be checking if anything that I need to know as we continue. But let's get back to the class. So we're learning about investments. I know you've heard this before, but today we're going to define it, to expound it, and go a little bit deeper into the world of investment. Investment is what separates rich people from poor people. People who are successful, they invest their resources. People who are not successful, they do not invest their resources. So if you want to be successful in your life financially, you cannot avoid to understand investments. So understanding the fundamentals of investment is what we are going to deal with today. We're just going to deal with fundamentals. This is not going to cover everything that we need to know about investment, but it's going to wake up your desire to want to learn more and actually implement based on your area. I know we are all from different areas here, but based on where you are, you will look into opportunities for you to start investing even better than you're already doing now. If you're doing investment already, that's good. If you're not, this will put fire on you to go and start to learn and then implement the things that you're learning here. All right. So what is investment? One simple, clear definition of investment, if you're writing down, investing is committing money to assets or projects with the expectation of future income or profit. You're committing money or assets. You're committing money, to assets or projects with the expectation of future income or profit. So every time you invest, you expect to get income or profit from your investment. No one goes to invest because they want to lose all their money. You're going to invest because you expect to get income or profit. Why does it matter? Why investment is important? Globally, investment drives growth and builds wealth. Investing households often have far higher net worth than those who do not invest. So based on research, those families, those households who invest, they have higher net worth compared to those who don't. For those who were here in the class last week, we did look into what net worth is. But in short, if you were not here last week, net worth is assets minus liabilities. You have your net worth. Your assets will be things like cash or money in your bank accounts, or if you own any investments, stocks, bonds, mutual fund, whatever, properties, land, farm, houses, you own any other things that are valuable except cars, because a lot of people think cars are assets. Those are very temporary assets. They pass, they go, they depreciate quickly. But those things combined, minus liabilities, everything that you owe, any debt that you have, anywhere in the world, if you take all your assets, you minus all the things that you owe, what's left is your net worth. And investment grow your net worth. So you don't want to be like that guy we just read about and have your money and you dig the hole, you put it under the hole. Some people used to put money under the mattresses or the pillows. That is not what we're doing in today's world. You have to invest your money. All right? So core beliefs or core benefits, the core benefits of investing is to pursue capital growth, to earn income, to hedge inflation, and to secure future financial needs. So when you invest, what are the benefits? Why are you investing? These are the benefits. You want to grow your capital. You're investing because you want the little money that you have to grow so you can be able to do even greater things. So you decide to invest your money that is not enough for what you want to do. You want to grow it so you can be able to do greater things with a bigger capital. That's one reason for investing.
Brother Amos, I hate to interrupt. But can you slide the slide over off of the money and over into where you have the agendas written out so I can write the proper notes so I can read along with you? I have it over here on the is there any way you could slide it the other way there you go. Yeah, so we can see the definition and follow. On my screen I can't, it's just the money. No, over to the other. Yeah. Yep, more over that way. Yep, exactly.
I'm not sure if it's gonna move. I'll try.
If you could, there you go. So just.
Oh, I just messed it up.
I'm sorry, but if you can, I'll let you get back. But that's yeah.
I just messed the whole thing up. Okay. Okay, I'm sorry if you cannot see it. That's we're gonna have to make other arrangements in the future to be able to make it in a way you can see it. But for now, I can repeat. If there's something you want me to repeat, I can repeat. And make sure you get the notes. I will be reading, and if you want me to repeat anything, I can do that. Just let me know. All right. So I was at the core benefits of investing. To pursue capital, you want to grow your capital. To earn income. If you have a sizable amount of money that you're investing and you invest it the right way, it will be giving you income. This is where you see some people don't even go to work, they don't do anything, but they still live a good life because they have invested the money and the money is working for them. It's earning income for them. This is where total financial freedom is, because you are now working for money. You work because you want to work. So investment can earn you income. But also what it does, it hedges inflation. If you have $1,000 today, 5 years from today, that $5 will be worth nothing. That $1,000 will be worth nothing. So you don't want to just put the money sit there. You want to invest it. because it grows to defeat the inflation. The inflation is when the prices of things rise up in time. You want to make sure you're keeping up with that, or at least you have to exceed that. So that's another reason you invest your money. Another reason is to secure future financial needs. You invest for now, but also you invest for the future. That's very important. Most people don't want to think about the future. They're thinking about where they are. They're satisfied with where they are, and that is wrong. You need to think about where you're going and how things will be for you when you get there. Investments gives you that safety and that peace of mind that if God lets me live this long, then I'm going to be okay if I live that long. You'll be surprised how many people pray to live a long life, but they don't want to be prepared for that. How are you gonna live when you're 70? How are you gonna live when you're 80 and 90 if God gives you that long life, or 100 years? How are you gonna live then? Who do you expect is gonna be there for you to take care of you? Don't say I have children or I have relatives and all that. You don't know anything of what they're gonna do at that time. It is your responsibility to prepare your own financial needs for the future. So this is the moment. That's why we're learning this, so you can do everything it takes now. Don't wait until then. All right. Risk return diversification. Risk return diversification. Now, a lot of people don't want to invest money. When I talk to people here, for example, in the United States, who do not invest their money, they will tell you because of risk. I don't want to lose my money, so I'm going to keep it in a savings account in the bank. Let me ask you, when you put your money in the savings account in the bank, what do they do with it? Do you think it's sitting there in the bank? No. They are taking your money, they are investing in those areas that you are afraid to invest in. They are investing your money, they are benefiting from that money that they invest, and you get nothing. So, risk is real, yes. But risk should not be the reason you don't want to invest, because all successful people financially, they invest their money. You just gotta be smart with it. You cannot run away from investing your money. Now, low risk, low return. Investments such as government bonds and savings accounts offer stability but limited growth potential. Ideal for risk-averse investors seeking capital preservation. If you are very, very, very afraid of losing your money when you invest in things like government bonds. Some savings account, most savings account you get zero. So I don't even call that an investment. But you can invest in CD accounts at a bank. A CD account is a certificate of deposit. Depending on what country you are in, you need to look for those accounts in a bank. If you are putting your money there, at least there will be a rate of return. There will be an interest that you earn from your money, and try to get at least 2 to 4% return from a bank. If it's more than that, it's even better. But most banks don't give you more than that from a CD account or any investment account in the bank. But if you get at least 2 to 4% from that, is at least good for those who are very, very, very risk averse. But high risk, high return. if low risk, low return. That's what I'm saying, like, 2 to 4% for bonds, for CD accounts and other things that are out there. High risk, high return. Assets like stocks, cryptocurrencies can yield significant returns, but are subject to greater volatility. Suitable for those with higher risk tolerance and long-term horizon. For those who can tolerate risk more, stocks is your area. Cryptocurrencies can be your area, but you still have to be careful how you deal with those. These over time will make more profit over time. People who lose money are those who may put money in an investment, they buy a stock, a share today, and tomorrow, because the market went down, maybe you bought a share for $100 today. Tomorrow the market goes down, your share is now $80, and you panic, you say, and you take your money out. Well, you bought it at 80, at 100, you take it out at 80, then you have lost money. You don't want to do that. What you want to do is to do something we call dollar cost averaging. You keep on putting money, especially when the market goes down, because you're buying the share cheaper, because eventually the market will go up. It has always done that for a long time, for hundreds of years, sorry, not thousand. So it has always done that. It will go down, but it will go up again. And the stock market is not going anywhere. They will always be here, and there will be ups and downs, but as they go up and down, they are going up. So you will always make money if you are for a long-term horizon. If you're emotional and you're looking at things just based on what's happening today, you cannot be an investor. Maybe you want to be a trader, which is something different. Now, diversified portfolio, combining various asset classes and sectors, reduces unsystematic risk, smoothing out returns and lowering overall volatility by 30 to 50%. So what do? You are somewhere, you are avoiding risk, but also you don't want to lose your money. You don't want to take too much risk. What do? Here's the solution. You diversify your portfolio. You do not put all eggs in one basket. You spread your eggs in different sectors, different markets, different types of investments. As we're gonna see, there are different types, but you wanna make sure you spread them. You don't put them in one place. For example, I've dealt with people, when one stock is going up, they're putting all their money there. GameStop everybody is buying GameStop. Everyone is buying GameStop. Then they put all their money there. And it will go up, but eventually at some point it will go down and you will lose your money. You don't want to do that. So you diversify. You buy a little bit of that, 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 and then you diversify your portfolio and you are good. So that's very important. Now, this applies to everywhere, to anyone, no matter where you are in the world. For those of us here in the United States, we deal with the New York Stock Exchange, we deal with NASDAQ, S&P 500. It's the same stuff. You have to diversify your portfolio. For those, for example, I have some people here from Tanzania. You need to learn about the Dar es Salaam Stock Exchange, what's in there. There are some companies there. There are also some other funds that behave like mutual funds, like UTT and other funds there. And if we have anybody here from any other country, then it's the same. You want to look at the different investment tools that are out there. And if your head is spinning right now as I'm speaking, you say, I understand all of these, I don't know where to start. I'm so confused. That's why I'm here. We will continue to move forward, and you can always reach out to me. I can help you on a one-on-one basis if you like to start that journey. But don't let anything stop you from pursuing your success, because your life, your family, and everything, your legacy depends on that. Now, another perspective is concentrated portfolio. Investing heavily in a single asset or sector increases exposure to specific risks, potentially amplifying both gains and losses. So you cannot concentrate in one sector or asset. You want to diversify. If you do concentrate on one, that is the point I just explained, you expose yourself to both great gains, but also it can be great losses. You don't want to do that. You want to be careful with that. All right, so moving on here. I hope you guys are learning something. You guys learning? Can I hear something? Can I hear somebody say something? Like feedback? Anyone say something? Are we together? Are we learning? Unmute yourself and say something, please. Class,
absolutely.
This is a class. Great. Somebody text, I think, instead. Yeah, somebody said yes. Great. I want to hear something. Don't make me just be the only one talking here. It's a classroom. All right. Investment terms explained. Once you start getting into the investment world, if you haven't, you will hear some terms. So I picked just a few of them and try to make you aware of them. So when you hear next time somebody say that, you sound a little bit professional. You know what they're talking about. All right. So some core market terms. You will hear people say about a bull market. What is a bull market? A bull market is a prolonged period when prices broadly rise and investors' confidence is strong. A bull market is when things are going great, the economy is doing great, the stock markets are doing great, people are investing, people are seeing their portfolio go up. You know, it's a bull market, things are great, things are going up and everyone is happy. That is a bull market. A bear market, on the other hand, stock prices fall 20% or more from recent peak. For example, we may get to a peak, a place of peak where, you know, people have made so much money because the market is doing great. It looks like in the United States, we are going to that direction of bull market. I don't know. It's been up and down, but things kind of look a little bit bullish right now. But if we continue that way, we're gonna get to a peak. Remember, it's a curve. So any curve, it will go up and it get to a peak before it starts going down. So when you get to a peak, things starting to fall, and if it falls 20% or more, if always with us widespread pessimism, people are very pessimistic about investing. People hesitate. A lot of people may even pull their money out. The ones who panic, the ones who go with emotions. That's when you know you have a bear market. It's like the market is downturned and investors are being cautious. You're not just putting money, you're not just happy, you're kind of observing and see what's changing, what's causing this market to behave that way. You're being cautious at that moment. Liquidity, what is that? It's how quickly an asset can be sold at a fair price without causing a significant loss. Higher liquidity generally means faster, easier sales with tighter bid-ask spreads. Liquidity, in simple terms, it's how easy you can take your money out. If your investment has high liquidity, means you can easily sell your assets, and then you can be able to get your money. Some are not done that easily. Some put terms, maybe quarterly, semi-annually, or annually, or even longer than that. Once you put your money there, you agree that you're not touching it until that time comes. So you want to make sure you understand liquidity, how liquid is the asset based on your goals for investing. If you want to invest something and get that and be able to access that money in 2 years or 2.5 years, 3 years, then you need to see that investment vehicle, would they allow you to do that, or they are not as liquid, maybe they allow you to access your money in 5 years. Now, throughout all this time, that money is still yours. If something really has to happen, you can still access your money, but this is the terms, and some people make it a little harder for you to access that money before the term, and you may even get penalized because they want to make sure you keep your money there so you can grow according to your goals. And if they let you do that before time, you will not reach your goals, and also they will not reach theirs. So yeah, it's a win-win here. Everybody has to win. So that's important to understand. Liquidity is how faster or how fast you can access your money. Performance and allocation. What is this term, alpha? When you hear people say alpha, it's the excess return an investment generates over its benchmark after adjusting to risk. Excess return. So you invest and there's a return, and that return is assessed, and if there's excess return, that's alpha. That's good stuff happening right there. A yield, the income an investment pays, expressed as a percentage of its price. So if you invest in some stocks or whatever other things that you invest in, and they promise to pay yields every now and then, that is the income. If you have a lot of money and you invest where they pay yield, that means that is the income that you can always spend the money and be able to live off of. But if you don't have a lot of money, you're trying to grow your money, you probably don't want to take that yield out because it's a small percentage. You want to put it back so it can continue to grow. Asset allocation is how you spread investments across stocks, bonds, and cash to balance risk and return. So it's how you spread your dollar. You can have the same dollar, but you spread it out in different areas to balance risk and return. You're balancing both. You're balancing risk, you're balancing return. All right, so let's dive into looking into investment vehicles. Where are we investing? When we're saying we're investing money, we're investing, where are we investing? Because, if you have not done it, then it's like, where do I invest? This is good talk, but where do I put my money? And I want us to take a dive into that. Now, these are common traditional investments. There are other investments we're going to look into, but these are traditional and they have worked for many, many, many years and they still do very, very good. And that's for the majority of people. This is where their money is invested. Stocks. Stocks are equity ownership with historical real returns around 7 to 10%. This is historical, meaning throughout the times, even during depressions and all that, averaged out, these stocks, they have still been able to perform at a profit. Some years, sometimes the average return has been so much higher than 7 to 10%. This is historical, so it averages out maybe the World War II and Great Depressions and everything that we've ever been through, COVID and other diseases and the hungers of the world, everything, they are factored in, but these were still able to make a profit. So those are stocks. A stock you are buying, there's somebody, okay. You're buying when you own a stock, you're buying a share of the company's ownership, of the business's ownership. So and those shares, they have their price. You're buying a portion of that company. For example, if you own shares with Amazon, that means partially at that small fraction, you also own Amazon. This is a cool way, people, to own things. Buying stocks gives you ownership of that business. So for those of you who have always wanted to own a business and you haven't been able to own a business, here's your chance. You buy stocks, you own that business, at least at a small portion. And now, stocks prices, they change. They always go up, but they go up, down, but they go up. So for example, if one stock is sold at $500, but you wanna buy a portion of that, because you only have $100, you can do that here in America. They let you do that. You can own fractional shares. You don't have to purchase the whole stock. You don't have to buy the whole big chunk if you cannot afford it. That's the good thing about investment right now. You can invest your $50, your $20, you get $10. You can invest any amount. You need to get started. If you haven't, you're being late right now, because the longer you wait, these things are appreciating, they're going up, and you're missing out on the opportunity to gain. So stocks are ownership, equity ownership. If you own a stock, you are important because you are an owner. At least that small fraction gives you a small ownership of that business. Bonds are debt instruments offering steadier, lower risk returns. Like I said, near 2 to 5%. Bonds will not yield bigger returns. They are safer, they are steadier. These are debts. With stock, you own ownership. With bond, you are the lender. You gave money to these companies that they need money to grow their businesses, and you gave them money, and you will be getting interest paid to you based on how that business performs. So for stocks, you own equity. For this one, you own that debt instrument, and it's going to give you money based on how those areas perform. Now, these are mostly government bonds, municipal bonds. They are more controlled. They are very careful with them, and the risk is very minimal. They invest in very, very, very specific things that people will always need, and it's safer there, but the return is lower. Mutual funds. Mutual funds are pooled, professionally managed diversification. Over 50 trillion managed globally today in mutual funds. Mutual funds manage a whole lot of money. Now, mutual funds, these are funds that different stocks are combined from different sectors and assets and all that. They are put together. A mutual fund is a pool. Money is pooled and brought together. You are putting your money there with other people, and then these are managed. They are very carefully managed, and they are diversified already for you, so you don't need to worry. If you're purchasing a mutual fund, they have already done the diversification. These are professionals. They manage that. They know when to move from where to where based on what's going on around the world or in the sector or that. People who are paid to do this day and night. So when you buy a mutual fund, there will be some fees, a little bit fees that you pay there, because all these managers, they need to get paid. So what you earn, also you pay a little bit portion of that so the managers can continue to manage. But overall, mutual funds will perform way much better than bonds. Because they are diversified, they will perform according to how the markets go, but they are managed, so you are safer than somebody who just purchased stocks. So that's the difference. Now I see somebody just came in. I think some people, maybe they missed the memo about 1 o'clock. Maybe they think it's 2 o'clock. If you're just coming in now, sorry, we started at 1 o'clock today. We have changed the time because some people asked, and there was more than one person, and we felt like, okay, we need to consider those who are abroad, because 10 o'clock is a little bit too late for them. They need to sleep and go to church the following day. So we started early a little bit. So if you're coming in now, welcome. We will continue. Today we're learning about investments, and this is an opportunity for you to be able to understand investments and your options out there, and how you can jump in before you miss out in these moments that we live in. Remember, smart, wise people always invest their money. Somebody just said something. Let me read that. Wait, it started at 1 o'clock. Yes, it started at 1 hour ago. So yeah, Jerry, sorry about that. I posted that in a group. I think you missed it, but it's okay. Stay with us. There are still good things we're doing here. We're not done yet. And then the first portion, you get to watch the video that will be sent next week. So you're still good. But stay here for now. All right. Okay, so continuing here. So we're talking about these traditional investments. We just went through stocks and bonds and mutual funds. If anyone has quite a question about those, let me know as we continue. But if not, I'll move on. I hope my explanation were good enough. So what I want to insist here, don't look at the stocks and say 7 to 10%. You say, that's all I can get, 7 to 10%. This is historical. Like I said, throughout all these bad times and crazy times and the economies of the world shaken, all that, still the stocks have been to perform at a profit on average. But we live at a time, if nothing else crazy happened, the markets are doing great, although they go up and down, but they're doing great. And if you invest now, you will earn so much more than 7 to 10%, unless something crazy happened, which we don't know. We leave that to God. That's why we pray, y'all. So, so there can be peace and things can go well. All right. So, moving on here. Alternative investments. So when we look into liquidity, hedge funds often allow quarterly or annual redemptions. These are private equity and real estate are less liquid with multi-year lockups. So, like I was saying earlier, now we're going a little bit deeper. When you invest, you need to understand your goal. Why are you investing? Liquidity means how faster you can sell your shares and cash out. Hedge funds often allow quarterly. That means you can do that how many times a year? Good students, I know you said 4 times. That's the meaning of quarter. Or annual. So there's an option that I don't want to touch it. I want to see if I can revisit that every end of the year term. That's for hedge funds. Private equity, though, and real estate are less liquid with multi-year lockups. What is a hedge fund? I had to define this for you if you don't know it. It's an investment that pulls money from wealthy investors and institutions and uses advanced and flexible investment strategies to generate high returns. A hedge fund is an investment that pulls money from wealthy investors and institutions and uses advanced and flexible investment strategies to generate high returns. Guys and girls, for those who have been here since the first class, once you start those milestones, I don't know where you are right now, but you will get to a point where you have a little bit of money to invest. I say, don't jump too much into heavily doing investment if you don't have at least the emergency fund and stuff like that. But once you have at least, you say I have 10,000, I want to invest. You wanna dive into things like this. You can start even at any time, but if you have money to invest, hedge fund is one of the places. And why? Because wealthy investors and institutions, that's where they invest. The average person out there, they don't know that they can invest at the same place where these multi-millionaires invest. They invest in places like this, hedge funds. Why? Because they use flexible investment strategies to generate high returns. You get high returns, your money is with people who have learned, who are trained, and these wealthy people, that's where they put their money. So they are making sure they have the best of the best. Take care of those. So you wanna make sure your money is there too. You wanna make sure your money is there too, and it's growing in there, because these wealthy people, they will fight the policies of the country, the world, everything, to make sure that things are not changing and go against their investment. These are the ones who run the show. These are the ones who dictate policies of countries and nations and all that. You want to make sure your money is there too. Return potential. Hedge funds target absolute returns. They do not go for a loss. They target absolute return. Top quartile private equity historically 15% rate of return. 15% in average, guys. This is a big deal. Remember, we just saw bonds 2 to 5%. Stocks can go up, can go down. It doesn't matter. There's one stock I started to try a little bit something there last year. Just before even it's a year, it has gone up 32%. 32% in months. But that can go down. Hedge fund averaging at 15. This is crazy. It's a crazy opportunity. And I want to encourage you guys to learn this stuff and implement so you can actually be able to invest in hedge funds. Risk. Hedge funds may use leverage complex trades. Private equity faces business market risk, real estate risk ties to property cycles and debt. There are still risks there, but like I said, they look at them very closely. Investment horizon. Hedge funds 1 to 3 years. Private equity 5 to 10 years. Real estate 3 to 7 years. So you have to see your horizon, how far you want to go. Remember, investment is always a long-term thing. As much as we're thinking now, we want now, but also you have to think about long-term. So hedge fund, you should think 1 to 3 years. Don't say, I'm going to put my money tomorrow in a hedge fund and next week I'm going to take it out. You're not serious about investment. Investment takes time. Private equity 5 to 10 years, real estate 3 to 7 years. What is private equity? PE. This is pooled money to buy ownership stakes in private companies. Businesses that are not listed on the stock market. There are businesses that are startup, they are growing, they are doing great. They are not yet listed on the stock markets. They are not on New York Stock Exchange, London Stock Exchange, Dar es Salaam Stock Exchange, whatever. My book here, one of the pages towards the end, I listed so many stock exchanges here. If you want to learn about stock exchanges, make sure you have your copy and do read the book. I know some of you have the book. The question is, have you read the book and are you applying what's in it? But that's a different topic. But, private equity is pooled money to buy ownership stakes. So people put money together and they see these companies coming up, they're doing great, and they are not on stock exchange yet. I see somebody joining now. They are not on stock exchange yet, but they are doing good. So people pool money and they buy shares, they buy stakes, ownership from these great companies that are coming up. They have not been able to be listed in the stock markets yet. You also can put your money there and say, I believe in these companies. They have a potential to do great in the coming years. These are the companies where Some people end up becoming millionaires so quick because you put your money before they are publicly traded. You put your money there, and if they indeed end up doing so good, then your money grows so quick at some point when they become publicly traded. You want to go in, if you can, before they become publicly traded. That's very important for you to learn and understand about private equity if you are a serious investor. And that's how you diversify your portfolio. You want to invest in mutual funds where the companies are already publicly traded. You want to go to hedge funds. You want to buy stocks and all that. But also you want to go to private equity where these companies are not publicly traded yet, and put your money there and pray that things go well, because you can talk to God and say, God, my money is in there. God, please let your hand be with those investments, and you rest and you wait and you do other things, but your money is there. And one day you'll be surprised when you see those things start doing very good for you. So that's that. We continue here. All right. I see people coming in late. Oh my goodness, my goodness. People are coming in late today. But it's all good. I think a lot of people thought it was 1 o'clock. I tried to they thought it was 2 o'clock. I tried to communicate that in platforms, but I know some people missed it. So it's all good. It's all good. For those who are coming in, we have changed the time. We start at 1 o'clock, not 2 o'clock anymore. So whatever the time, based on your region, go back 1 more hour. That's when we start. But I will continue. I see some people just join, Rachel and other people. You've missed a little bit portion. We're going towards the final stretch of this, but we are learning great things here about investments, because I want all of us to be knowledgeable about our investments and really do be able to invest our money. So I will continue here. Emerging options. These are new things in recent years that have come up. Cryptocurrency growth. You guys, some of you know, and you follow up with this. The mutual fund worldwide, as you saw that it had 50 trillion money under management. The cryptocurrency, it has 2 trillion. Now, this is emerging. There's a lot of people who have generated wealth here because when crypto came up, nobody understood it. People thought it was a scam, including myself. I was like, I'm not touching that. I'm not putting my money there. I don't understand it. But those who were, they could tolerate, they have a higher risk tolerance. They put their money there, and a lot of people became very, very successful. So, you know, if you have played with cryptocurrencies, you know Bitcoin, you know Ethereum, and other ones, and that, you know, it's a big world. I'm not going to dive into that today, but I just want you to know that this is a place where people are doing great. It kind of behaves like stocks, sometimes the ups and downs and the volatility, but you know, if you take time to learn and invest in it, you know, you can succeed. Another vehicle is P2P. What is P2P? P2P is peer-to-peer lending. These are online platforms connected. They connect lenders directly to borrowers, typically offering 6 to 12% interest rates in exchange for taking higher default risk. They're online platforms. Connect lenders directly to borrowers. So with these, these are these are peer-to-peer lending. They have managed their, it's not random, but this is like, for example, if you have money and you say, I want to invest it, so others want to borrow money and they cannot go to the bank. They don't have collateral to go to the bank, but they want capital. And those who are managing these P2P money, they can look into what they're doing and decide, yeah, we can lend money to this person, and then your money was part of that, so it's lended to this person, and they are going to pay back with interest, and that's how you grow your money. So it's a pool of a big chunk of money in there, and you get to put your money there as part of that. And borrowers borrow money, they return with interest, usually no collateral, so there's risk there. It's different from banks, but even with risks, the reason these exist is because they still make money. They still make money, 6 to 12% interest rates in exchange for taking higher default risk. Investors earn by lending money directly to individuals or businesses through peer-to-peer lending instead of through banks. So next time you see P2P lending yields or P2P lending, you understand what it is. Risk and due diligence both expand opportunities but demand robust risk controls, platform vetting, and awareness of regulatory and market volatility. So that's about cryptocurrency and P2P lending. These are kind of emerging things. They are out there, they're doing good, and you want to dive more and see what options of investment are working for you. For my friends who are abroad, if you're in Tanzania or other parts of the world, you may not have all these options, but it's important that you understand them and see what you have there at your disposal. I was looking in Tanzania, there's so many things that are coming up and investment vehicles that you want to explore and be able to take advantage of that. So don't be discouraged and say, oh, we don't have this like the US. I get it, but there's still other things you can do out there, which the next segment, I'm going to talk about the local to global investing as I look into different things that people do outside of the stock markets for a little bit. Local enterprise investing. These are things that people do in their community. They invest in different things. Now, investment doesn't have to be on stocks and bonds and mutual funds and this and that only. It can be just some enterprise initiatives that people do. But you have to be careful with those. Don't go with emotions. I tell everyone who aspires to be an entrepreneur, don't go with emotions. Research, research, research. No research, no data, no right to speak, no right to start anything. I made my share of mistakes throughout my life. I started things without doing research. I started things with emotions because I believed they were going to work, and I have failed miserably and took great lessons. So hear me out when I tell you, don't start anything without research. I mean it. You will thank me one day if you take heed to this advice. Community growth and impact. Investing in local pop shops and enterprises can catalyze neighborhood vitality while delivering social returns alongside financial outcomes. Rising investor interest. Community funds and impact strategies have grown over 15% annually globally, reflecting momentum in sustainable and place-based investing. Risk and liquidity. These opportunities often carry higher unique risk and lower liquidity than public markets, requiring careful due diligence. Case studies and data. You can do your own research and see in your area what is it that you want to invest in, what area, what sector. I've seen people invest in making cake and make a lot of money, or baking cookies, or selling accessories of electronics. They make tons of money. But not everybody who start those things make money. There's a difference between those who do and who don't. I've seen people do farming. You can do farming and make good money. You can grow crops. You can grow permanent crops, trees of fruits and this and that, or seasonal crops. You can have animals. For my friends who are in Africa, there's plenty of land. You can acquire that and make tons of money that way. You just need to be careful and strategic. Don't go risking buying things and then you're not able to develop them and do nothing. And if you're depending on rain for watering your crops, you will suffer and you will not make good money. But you can start small. For my friends who are in the United States, but maybe you come from another country and there's opportunity for you to get land from that area, purchase land if you can and start small investment there. You'll be surprised how much it can grow. I was just talking to a friend of mine yesterday. He's from Tanzania, but he's lived in the United States for a long time. He purchased a piece of land and he is doing great things with that there. He has cow, they're milking them, they're selling milk, they're doing these great things, he's growing things. And just here in America, he can just be here without working and his projects back there are taking care of him. I don't know what your area. You want to be a barber, you want to start a hair salon, you're doing nails, you're selling purses, you're starting a store somewhere at a corner. All these are investments and they are so vast and different. I cannot tell you what to do. If you can do real estate, then do it. Buy plots and build houses and, do that. And then people will live in those homes and you'll be making money. What works for you? Do your research and invest. You cannot succeed if you do not invest your money. If you depend on the salary only, you will not go anywhere financially. No matter how big the salary is, you are not going anywhere because any employer will only pay you enough so you can go back to work. They will only pay you enough so you can go back to work. They are not paying you to be wealthy. They are only paying you so you can go back to work. So whatever you're getting paid from your job, don't try to live a fantasy life, a life that you cannot afford, a life that is fake so you can show yourself as a successful person. You need to steward every dollar very well so you can be able to invest it. It is important that you understand you are responsible for your own success, not your dad, not your mom, not your brother, not your sister, not anybody, not your family. You are responsible for your own success. It is crucial that you start now. Some of the things I know now, I wish I had known these things when I was 18. The funny thing is, those who are 18 don't want to hear these things. So the earlier you start, the better. But even if you are 60 today, you can still start. The founder of McDonald's, Ray Kroc, he started McDonald's when he was 57 years old. There are other people who have started things when they were older, and the advantage of that is that they were matured and they have built relationships, and they are able to utilize those networks to succeed. So every age has its own benefit. Don't count yourself out. Don't say, I'm too old, I'm too this, I'm too poor. You need to open your mind and invest. You invest what you can. That's why we started teaching about those principles, the 50-30-20 rule. If instead of 20, you can have 40% of all your monthly income invested, you are going at a faster rate compared to those who are investing nothing or just a little bit. So I encourage you to live within, actually not within, below your means. Most people live above their means. That is crazy. Live below your means. Remember, you can only live either above your means, within your means, or below your means. Those who live above their means are the ones who get their paycheck and they spend more than what they brought in because they want to show that they have a better life than what they really have. Those who live within their means, they get their money and they spend all of it. At the end of the month, they have zero. Those who live below their means are the smart ones. They don't care about what people think of them. They only care about what their goals and purposes in life are. You can laugh somebody who is living below their means. You can laugh at them today. Give them time. They will hire you and you will work for them. So you have to be wise with what you're making. Some of you are still younger. You can work 2 jobs or whatever you can do to make more money. If you have any means of making any extra income, that is what you need to do. You make that extra income and invest it, not spend it. You make extra to invest, not extra to spend. But just remember, first things first. So, ladies and gentlemen, I don't want to keep on going for too long. For those who came late, we will continue with this class, obviously, next week, because I want us to get the investment thing very, very, very well. You know, don't miss any class, because when you miss the class, then you're missing out the flow of what we are teaching. So don't miss any class. Push everything, because I believe for those, a few of you who will take this seriously, your life will never, never be the same. You're changing your life for the good, for good. So we will continue next time. But just as what we've learned today, I want you to take these things and implement. Now, I know I have raised a lot of curiosity and questions and things that you want to know more. If you need one-on-one coaching, I'm here to help you. You can reach out to me so I can help you at a one-on-one level. But if you feel like you got what you need and you're going to start taking steps, you do that. But invest. Don't live just for today. Look for tomorrow and grow your wealth. Live your purposeful life, because God called you here on earth to be successful and help other people as well. So I'm going to stop sharing and I'm going to allow questions if anybody has a question for now, and then we will continue. And I'm going to stop the recording. Yeah, that'll be it for now. But I will allow questions or comments, or if you have anything that you want to say, I welcome you. Thank you very, very much for listening. And now we're going to the session of questions and answers. And I'm going to stop the recording right now.